So what happens is, once that's done, they send the payment directly to the servicer, and then the servicer disperses the funds to the proper parties, like the mortgage in the first position, and then any profit to me and any tax and insurance that's also included in the monthly payments. So that's kind of how the wraps of the notes. I'm actually doing one right now where I'm buying the property, and I'm tacking on $79,000 on that particular one because we had to go and do a little bit of work, and then we're wrapping it to our end buyer. And usually you can sell, whatever the ARV is, the after repair value, you can usually sell that above the market value a little bit, so you can get a premium on it because you're structuring it where they can't go through your traditional bank to get the financing.
What's the
Now,
total?
Let's back up a little.
Yeah, go ahead.
Go ahead.
I said, what's the total
Well,
debt
one
on
thing I
that
want-
deal? What's the total county line lien debt on that deal?
Yeah, so they had to put, I actually sold it. I'm just using that one. the
Yeah.
two-
So the
200,000.
subject, what was
So
the
you really-
underlying number? The underlying number was 150, you said?
Well, yeah, for the first mortgage, let's say
Right.
Bank of America.
Yep. And then you wrapped it with
$150,000,
$200,000 wrap note. So the total, we had this conversation yesterday. What is that total debt? Is it 200 plus the 150? Or is it
No, it's
200
200.
total? So is that
200
50
total.
grand seen like a secondary or a second note on the property lien?
Yeah, so it would be second, but they're wrapping both into one, so it's creating that one note.
Yeah, Mark and I
Does that make
talked
sense?
earlier this week, and so it's not if I'm going to buy that note, I'm not necessarily in first, but I'm not really in second either. So it's kind of like I'm like 1.5.
Wild West.
Betweenish.
But you would be the one, because what happens is in this scenario,
Mhm.
because you have that note, you would keep paying the first mortgage, the mortgage, right? But you're foreclosing on with the buyer, the borrower, you're foreclosing, but for that 150,000 or the mortgage, and you're going to keep paying that. So that, and then you can turn around and resell the property again. So you're taking a property back because you're wrapping note, but meanwhile, that wrap of the 150,000 of Bank of America, you're still paying that. So they're still getting money. And the reason why you want to do that is, like, you may have a 2.5%, 3% underlying debt. So you're going out there, note buyers, you're borrowing money, what, 8-10%, when you have a debt already in place at 3% or whatever, and it can be paid off sooner. So that's the advantage of that's how that would work. Now you do have the underlying risk of, like, what's called the due on sales clause. However, that's very rare that has happened, but you should be aware of that, where the lender could actually call the note due, because for whatever reason, usually they don't do that unless the payment is not being made. Now, or if it's a credit union, sometimes credit unions may do it, but the big boys, they don't care. They just want, especially nowadays, the banks and stuff, they don't care as long as that payment is due, because with the new regulations, every time there's a delinquent, they have to put, what is it, like $2 or $3 for every dollar aside on that. So they just want those payments coming in, because let's say it's a $200,000 delinquent note, then they have to put an extra up to $600,000 aside on that. I don't know if that's exactly the numbers, but it's roughly about that. So anyways.
So we have some questions coming in, and I'm going to read them since they're on LinkedIn. What are some of your thoughts on giving seller mortgage while purchasing power of a dollar is declining? Aren't you getting paid in future dollars at today's rate, but value is reducing? We're not better of borrowing as opposed to lending. I'm not sure exactly if we understand that question. Rakesh, if you can kind of clarify a little bit more. Would the lender not start the foreclosure as they're prohibited in a second? So I guess the question is, when you say lender, Rakesh, are you talking about the underlying subject to original lender? Or are you saying is the wrap note? The wrap note can foreclose. They can still foreclose if that borrower is stopped paying. You can do that, right? It's still looked at the lien on the property and you're secured by that situation. So we're talking recently about the partials and the hypothecation is you could go ahead and buy that wrap note from you, right? Especially if you got it with equity, if you're into that deal for 200, but you're into the property for maybe 100 grand, you could sell me that note for 150 and you wrote it at 10% interest rate. We could get a really nice discount and make sense for both of us and get your money out. Another way of doing is buying a partial where you can buy 60 months of payments, right? And then I take ownership of the note. Last week we talked about hypothecation, which I think is probably be the best way of doing it, where we literally loan you money on that first or second, and we just charge you an interest rate, and we're protected by the security of that note. So that if you go bad as my borrower, I get your note. And if I bought that note that's worth 200,000 and I give you 100 grand, right? And I'm getting payments and you default, guess what I get in my hands? A $200,000 note, right?
Mhm.
So hypothecation, I'm not responsible for handling the note. You as the seller, as the lender, original lender, gets it, can maintain it. If it goes bad, you can transfer it to a different note. So hypothecation is actually a great way for wrap note people who own wrap notes to literally get some money off their books, as well as continue to buy more. As long as you keep making payments to us, we're becoming your bank. And if you have good equity and you wrote numbers well, your interest rate's high enough and your term is good, you can make a killing, and we can do this over and over and over again. Again, remember, me and Nathan are two different companies. We will buy as much as you have if the numbers work out well. And one of the key things for you guys is LTV. It's not a killer for us. We're more interested in our yield. So those who are curious about it, we're interested in our yield numbers.
Yeah.
Yeah. So if you have questions about that, please put in the chat and we'll do our best to answer. Because I know we have different people on right now, people in the seller finance, owner finance world, part of Mark's group listening, our group, as well as LinkedIn, and I think Twitter's on as well. So this will be recorded and put on YouTube. So Mark, when you do these kind of things, for those who are curious, where do you find your borrowers? Where do you find your properties? Are you doing mailers?
Yeah. How are you sourcing?
Mailers is a good way. Yeah, mailers definitely could work. I don't personally, but I have some of my students, they do some mailers. What they're doing is they're pulling some data, people that have been owning, there's so many different ways. Like I like to buy seller financing for people that have originally been investors that own the home for like 15 plus years, mom and pops, where they like that passive income. They don't want to get hit with capital gains, so they're willing to carry that note. That's kind of what I like to do. And then I also, when I'm talking to those people, I said, down the road you can actually sell your note as well. So that is another angle where you can kind of go in there, like, if you're buying a property yourself and you want to do seller financing, you can have them do seller financing for you, and then they could turn around and sell that note if they want some cash out of it. So that is another approach. But for me, I have a lot of referrals. I have about, over 600 bird dogs that feed me deals. And I work a lot with realtors as well. I work with a lot of other investors. I just built up a big referral network but also right now, like I'm teaching my students to go into systems like PropStream or any of those and look for people that just did an FHA or VA loan, like within the last year or two, and they're selling it. There's not going to be any equity there because those are 100% financing. So we can buy those subject to the existing mortgage or an agreement for deed, a contract for deed. So that's kind of where I'm finding a lot of our people right there. So there's a lot of different ways. A lot of times people come in like, where do I go? If you take a step back and you start networking with people and start listening, you'll start to understand what paths to kind of go through to try to find these particular sellers.
Do you have specific areas that you like to concentrate in, different states that you like, or ones you avoid?
I will look at every state. My exit strategy will determine on what state it is.
Okay.
Like we have one right now in New York where one of my students, he wants an exit lease option. I'm like, this comes back, because of the landlord tenant laws, versus I told him the best bet might have been an agreement for deed or a land contract. But because of the person doesn't, because you have to do a double closing on that. You're buying it from the seller, then you turn it on wrapping it. So there's not a lot of capital. They have to come out of capital quite a bit. So that's kind of why they're doing the lease option route, because it's less money to get from your end buyer. So, but usually in those type of states where they're not landlord friendly, I'm definitely looking at having a seller financing strategy, because at that time you're just structuring it, putting it together, and then they actually like it because they're homeowners. They take care. It's a different type of person. They take care of the property a lot more if they know it's their home.
Yeah, I agree.
Sorry about the echo, guys. Appreciate it. So I wanted to get into the 80-20 thing you talked about briefly. Is that this 80-20? what is an 80-20 note and what does it mean for us note buyers and note sellers? Why create an 80-20? What's the benefit of it and what's it look like?
Okay, well, let's use that scenario of the $200,000 note that we talked about. Let's kind of go down that path. Let's just use that one, for example. So I am the investor. I'm actually going to sell that property for $220,000. Okay, I'm going to get $20,000 down from my buyer, up front. So they have some meat in the game, if not more. It actually could be more than that. That's only 10%. So 15-20%, you can get up to $30,000-$40,000 down. So you want to get a large down payment, and then the remaining balance, say the finance amount is 200,000. Well, what they could do is they can structure that where 80% of that is, what is that, the numbers? 80% will be the first position, and that's
160,
where
yeah.
you can set it up in a way. Yep. Oh, I'm sorry.
160. So 80% of 200, 160, and then the other 20
Yeah,
would be
so it'd be
40,000.